Hello everybody and welcome to part 2 of our Module 11 session covering the topic of managerial accounting and cost. Now Module 11 is the first module where we start covering managerial accounting, and this is part 2 of that module where we're going to dig into a couple of the different types of analysis that we need to make. First of all, in part 1 of this module, we covered the topic of variable versus fixed cost, and we brought in the discussion of mixed costs, which mixed costs are also called semi-variable or semi-fixed because they have a little bit of both variable and fixed. The example I gave in part 1 was utilities, where there's a flat rate, kind of a connection fee. Even if you do not use any kilowatt hour of electricity whatsoever, every month you're still going to have that flat rate. There's also going to be a variable rate per kilowatt hour on top of that. And that's the variable cost. The first is fixed, then we have variable. So the problem there is for much of the analysis that we perform, we do need to know how much of a particular cost is variable versus fixed. Sometimes it's not that obvious. It's not listed out on the bill. So we need to know what it is. We need to be able to break it out into its variable and fixed component. So the cost equation we're going to look at, if we put in the variables for that, it's going to be Y equals A plus B times X, BX. Now we'll define what this is in a bit. It may look somewhat familiar to you if you recall the slope-intercept equation from math, where you use that for graphing various things. It's the exact same concept. For whatever reason in accounting, they decided to use some slightly different variable letters, if you will, but it's the same concept. Y is equal to the total cost. That's what total costs are referred to as. This is sometimes known as the dependent variable because Y, this variable, depends on everything else. It's the answer to all these other items. A is the fixed cost, also known as the intercept. It's the amount where we have zero activity. It's on the vertical axis. We have zero activity, but we still have a cost. That's our locked-in fixed cost. That doesn't change. B is the variable cost per unit, also known as the slope, how quickly that cost will increase as the units increase. X is the activity level. This is known as the independent variable because it does not depend on anything else. In fact, this is what once we get an equation going, this is the thing we change. We're trying to figure out cost at 100 units or maybe 1,000 units. So we plug this variable in to get an idea of what Y would be in that case. So here's just a very rough illustration of a cost line. So here we have at $300 cost and 0 units. The vertical axis is dollars cost. The horizontal axis is units. At 0 units, we still have $300 of cost because that's our fixed cost. Every unit thereafter, it's going to increase by $10. So that would be the rate, $10, and the axis, or the X, of course, would be the number of units we try to plug in. That'll tell us where on this cost equation we would be. Now, the whole goal of getting that cost equation going is so that we can predict what costs should be at certain levels. Now, there are a variety of ways to do this. We have what's known as a scatter graph, which means you take historical data from, this month's utility, or, January of last year's utility bill, February of last year. You plot out the total cost and the number of kilowatt hours, for example. You plot them on a graph, and you try to get an understanding of where that cost line best fits. Scatter graph is a very rough way of doing it, and each person that does it might get slightly different results. It's subjective. The HighLow Method, which is the focus of this lecture, allows us to actually create that cost equation and figure out where on the cost line a particular level of activity should fall. Regression analysis is a much more in-depth method that's beyond the scope of this course, but we do cover this in other videos. We cover regression analysis. It's very handy if you want more accurate results, and it's actually quicker if you have the right tool, whether it be Excel or some software to do this analysis. But again, for this lecture, we're focusing on the HighLow method. So the HighLow method, the step one, tells us we need to take a look at the past, 12 months worth of bills and identify the highest and lowest activity levels. In that earlier example, it'd be the kilowatt hours. It's the highest and lowest activity levels regardless of whether the cost for those levels is also the highest or lowest or not. You'd think that it generally is. If you have the highest activity level, it's generally the highest cost as well. But that may not always be the case, and we're really not concerned if it is or isn't. We want the highest and lowest activity levels, and then whatever cost corresponds to those levels. Now, if there are any major outliers where when you plot it on a graph, something that just seems way out of whack, you might want to eliminate that from the data set. Step two, we're going to calculate the variable rate by taking the change in cost divided by the change in activities. You may again recall that from slope-intercept form in math, but the variable rate is high cost minus low cost divided by high activity minus low activity. How many units were at the high and low activity points? That gives you a cost per changed unit is what it does. That's our variable rate. Now step three, we're going to plug that variable rate into that cost equation using either the highest or lowest activity levels, but you can't use any other level in the 12-month period. It must be the highest or lowest to guarantee accurate results. The idea here is we know the variable rate from step two. We were already given the activity level, whichever one we pick, high or low. We also know the total cost at that high or low activity level. The only thing missing in the equation is fixed cost. We have all the other variables. We can solve for fixed cost. So let's take a look here. We have these 12 months of data, a number of units that were produced, and the total cost related to each of those levels. Here we've plotted them out on a graph, and everything looks to be somewhat reasonable. Reasonably, we could plug a line through this. We're going to pick the high and low activity points. So June's the high activity point, and it just so happens to be also the high cost, which is fine. It makes sense that it is. August is the low activity level, and let's see, it looks like that is also the low cost, so that works out pretty logically. We need to know the change in cost. 1940 minus 1010, that's $930 change in cost, divided by the change in units, 120 minus 58, that's 62 units different. What we're saying here is that this $930 of additional cost is caused by the fact that we have 62 additional units. Therefore, our variable rate per unit is $15. The rest of it is all fixed. We take $15 per unit, and let's just pick the high activity level. We could have picked the low level, but we're going to pick the high level. Multiply the $15 per unit by 120 units. That tells you that at that level, you'd have $1,800 of total cost. At that level, we had $1,940 worth of total cost overall. We know we just said we have $1,800 of total variable cost. So the difference of 140 must be fixed. Now we can plug all that back into our equation and say that Y, total cost at a particular level, is $140 plus $15 times the number of units, X. Within that relevant range, this should work, and we could plug any X level and get a pretty good prediction of what the cost is going to be. So now let's move on to the topic of cost, volume, profit analysis. We extend this discussion in later videos, later modules, but we're going to introduce the topic here. And we are going to examine the relationships between revenues, costs, and profit, and how they change when the volume itself changes, the number of activities, the number of units we're producing. we need to understand selling prices, and they need to relate to our costs. They need to be above our costs, but they need to be reasonably above it to enable us to generate profit. We need to know how all of these things are impacted by an activity level change. That's the point here. We first need to assume a few things. We need to assume that all costs can either be classified as fixed or variable. If they were mixed, we need to know what the variable and fixed components are from the HighLow method. We assume that total cost is behaving in a linear fashion within the relevant range. And we also are assuming there's only one cost driver, whether it be number of units sold, number of dollars sold. That's what's driving both cost and profit. We have to either be a one-product firm, or if we do have multiple products, we have to know what the sales mix is expected to be. For example, if we have two products, do we sell 50-50? Do we sell even numbers of each? Is it more 80-20, 70-30? What's our percentage of each unit that sells? Now we're going to take a look and dig into the profit and cost equations. Profit is going to be defined as the number of units sold multiplied by the dollar amount sales price per unit. That's our revenue minus all the costs, minus fixed cost, minus variable cost, which is the number of units sold multiplied by the variable cost per unit. That's how we define profit. As activity levels increase, then obviously the revenues are going to increase and the total variable costs will increase, but the fixed costs within our relevant range will stay the same. We defined variable and fixed costs earlier, and we said the variable costs would include things like direct materials, direct labor, variable overhead, but it also includes variable selling and administrative expenses. The point is, these change as our activity level of production changes. Now here we're going to look at a few different types of charts here, illustrations. This is known as the contribution margin income statement. It's very handy for managerial accounting, although you won't see this on a financial statement. The contribution margin income statement is revenues per unit multiplied by the units sold. That's the same as our traditional income statement. But now we're going to subtract out all variable costs per unit multiplied by the units sold. These might be variable product costs. These might be variable selling administrative costs or period costs. It doesn't matter. The point is they're variable. We subtract those out and we get a contribution margin per unit, obviously multiplied by the number of units sold. And then we subtract out fixed expenses in total to get operating income. The idea here with contribution margin is that the whole goal of contribution margin is to contribute to knocking down fixed expenses and then eventually leaving us with some profit. Every unit, let's say this unit had a $1 contribution margin. It was priced at $1 above the variable costs. Every unit we sell is $1 off of our fixed expenses. We're covering our fixed expenses, and then when we're done with that, we'll have profit. That's the goal of this statement, as compared to the traditional income statement, where we have revenues minus product costs, whether variable or fixed. That gave us gross profit, and then we subtract out all period expenses to get operating income. We need this contribution margin income statement to be able to calculate the next few items. The next one we have is contribution margin ratio, and this is the contribution margin per unit, again, sales minus variable costs, and we're dividing it by the sales dollars per unit to get a contribution margin ratio. So if we had $100 selling price, $60 variable cost, and $40 contribution margin, our contribution margin ratio would be 40%. 40 divided by 100. But guess what? The other 60% would be our variable cost ratio. Now we're going to talk about the break-even analysis, and we're going to see how many units we need to sell to cover just those fixed costs. The idea of break even is that we want to know what our risk is, and we're not expecting to get profit. We're trying to figure out what is the risk that we may not even be able to cover our fixed cost, therefore we would have loss. So the break-even point in units, that calculation is fixed costs divided by the contribution margin per unit. If we have a total of $100,000 in fixed costs and a $1 per unit contribution margin, it's going to take 100,000 units to break even and cover those fixed costs. We could do the same thing and find the break-even point in sales dollars by taking the exact same fixed costs, but now we're dividing them by the contribution margin ratio. Instead of a dollar amount per unit, it's a percentage, and it'll tell us what amount of sales dollars we need to be able to cover fixed costs. Now, the next topic I want to illustrate is very, very similar, but it's basically saying if we want to cover a certain amount of target profit, then how many units do we need to sell, not only to break even, but also to cover that specific amount of profit? So the only difference to this equation is our numerator is going to be bigger. We're no longer just trying to cover fixed cost. Now we're trying to cover fixed cost plus the target profit. So we divide that by the contribution margin per unit, and we get the number of units to sell to hit that target profit. If we want to get the target profit point in sales dollars, again, we take that higher numerator with the target profit included divided by the contribution margin ratio. The final topic I wanted to introduce here is the operating leverage topic. This is calculated by taking the total contribution margin divided by operating income. Now, by its nature, assuming you're operating at a reasonable profit or at least not a loss, your contribution margin is going to be greater than your operating income. The difference between the two, of course, would be fixed cost. But the idea here is we want to divide these two, and we should get a multiplier above 1, and that multiplies or amplifies any increase or decrease in sales. So if we have an operating leverage ratio of 5, let's say, if we have a 10% increase in sales, that means we're going to have a 50%, 10 times 5, 10% times 5, a 50% increase in profit. But the same thing could happen on the negative side. If we have a 10% decrease in sales, we'd have a 50% decrease in profit. Now, again, the difference between these two is the fixed cost. The more fixed cost we have, and therefore the less variable cost generally, the more fixed cost we have, the more leverage we will have, and that's risk. The more leverage we have is risk, but it could be good or bad. Risk can be positive or negative. What this basically means is the more fixed cost we have, the more we run the risk that we might not even be able to break even because we might not have enough units sold to cover that huge amount of fixed cost. If we had zero fixed cost and everything was variable, there's no risk. Assuming we price our product at somewhere above variable cost, we're guaranteed to make a profit on day one with the first unit sold. So that's the risk that fixed cost gives us. But the benefit is that as soon as we cover that fixed cost, every dollar of operating leverage, every dollar of contribution margin goes straight to profit. Generally speaking, the more fixed cost you have, the less variable cost you'll have, thus the more contribution margin you'll have per unit. More of that sales dollar is left over because there's less variable cost to knock it away. That's the idea behind operating leverage. So that takes us to the end of this discussion. Now, we will be talking about some of these topics in more detail in the later modules. I hope this has helped to clarify some of these issues. I thank you for your time, and I will look forward to talking to you in the next session. Have a good one.